everyone, and welcome to my channel. In this video, we will dive into the crucial topic of the valuation of accounts receivable and the calculation of its net realizable value. This is a fundamental aspect of accounting that every student and professional should understand. Receivables, as a financial asset, are more than just theoretical concepts. They are the practical claims held against customers and others for money, goods, and services. For instance, when Dell sells a computer on account to one of its retailers, it's not just a transaction. It's an account receivable being recorded, a real-world application of the concepts we are discussing. Companies classify accounts receivable as current or short-term assets, as they expect to collect accounts receivable within a year or during the current operating cycle, whichever is longer. Unfortunately, not all customers pay their bills. We need to consider this when we report the value of accounts receivable on financial statements. We record credit losses as debits to bad debt expense or uncollectible accounts expense. Such losses are a normal and necessary risk of doing business on a credit basis. Accountants use two methods for uncollectible accounts: the direct write-off method and the allowance method. The direct write-off method, which records bad debt expense when a specific customer account is deemed uncollectible, is often used for tax purposes. Still, it is not allowed under GAAP unless the amount uncollectible is immaterial. The allowance method is acceptable under GAAP and is the method we will use in this video. If you want to learn more about the direct write-off and allowance methods, I am posting the link to the video here and in the description below. Under the allowance method of accounting for bad debts, we estimate uncollectible accounts at the end of each period. This ensures that companies state receivables on the balance sheet at the net amount expected to be collected, which is gross accounts receivable, less estimated uncollectible accounts. Accountants estimate uncollectible accounts using information about past and current events and forecasts of future collectability. Now, let's look at an example. This slide shows an analysis and aging of Stuart Corporation accounts receivable on December 31, 2024. Amounts estimated to be uncollectible: $180,000. Accounts receivable: $1,750,000. Allowance for doubtful accounts per Stuart's books: $125,000. We need to determine the net amount expected to be collected of Stuart's receivables on December 31, 2024. The key here is to decide which amount to use: the amount estimated to be uncollectible or the balance in the allowance for doubtful accounts. Since yearly sales and bad debt expense amounts are not provided, we assume that the company calculates the allowance for bad debts using the percentage of receivable approach, not the percentage of sale approach. I have a video discussing calculating bad debt expenses using the percentage of receivable approach. I'm posting the link here and in the description below. I encourage you to watch it to gain a comprehensive understanding of this method. Fortunately, the amount estimated to be uncollectible has already been provided to us: $180,000. We will need to subtract this amount from the accounts receivable balance to report the correct value on the balance sheet. If the amount estimated to be uncollectible is not subtracted, the accounts receivable value will be overstated. This can mislead investors and other stakeholders about the company's financial health, and it inflates the value of assets that are not fully collectible. As per Stuart's books, the allowance for doubtful accounts will need to be adjusted to record additional bad debt expenses. The net realizable value of Stuart's accounts receivable is $1,570,000, which is accounts receivable of $1,750,000 less the estimated allowance for doubtful accounts. $1,570,000 will be reported on the balance sheet under current assets as accounts receivable net of the allowance for doubtful accounts. Let's look at Tesla's partial balance sheet to see how it reports its accounts receivable. They call it accounts receivable net. The explanation is in the notes to financial statements. Tesla provides an allowance against accounts receivable for the amount it expects to be uncollectible. It writes off accounts receivable against the allowance when they are deemed uncollectible. I hope you found this video helpful. If you did, please subscribe, hit that like button, and ring the notification bell so you are notified when we release more videos like this. Visit my channel for more videos on financial and intermediate accounting. Thank you all so much for watching, and I hope to see you all again in the next video.